Now we're going into First Time Homebuyer Course 2, Section 2. We're going over some of the standard loans, government-backed. The reason why is because the government-backed loans are typically what you'll find for most lenders because they're guaranteed that money in case anything happens. So, VA, FHA, USDA, NADLS, and conventional. Let's get into it. Alright, so this is going to be the most popular type. This is probably going to be what most people are going to gear towards when selling a home. It's going to be easier to get offers accepted because they're going to require less repairs. How I got it broken down to me from a lender was if it has a working bathroom, bedroom, and kitchen, and it's not a safety hazard, you'll probably be able to get that loan. Alright, so credit score requirement is about 620. For a lot of these loans, that kind of changes from lender to lender and from area to area. From my understanding, conventional loans are kind of just like a flat 620 across the board regardless. So for down payment, 3 to 5% is standard. So let's say you got a $100,000 home, you're going to expect a $3,000 down payment. Now keep in mind you're also going to have closing costs. So that's going to be affected by like what are the taxes in your area for your home, what are your insurance costs that you went ahead and found yourself, and then you're also going to have stuff like state transfer tax, which is going to depend, state by state. So if you do have any questions about that, just shoot me an email, shoot me a text, and I'll help you out. So PMI. So primary mortgage insurance, you're going to be required to hold this for most forms of loans if you don't have over 20% of the loan paid off. So let's go ahead and say you bought let's stick with the easy numbers, $100,000 home. So if you went ahead and put a $20,000 down payment instead of the standard 3% or the $3,000, then you would get rid of PMI. What is PMI? You're essentially paying for the insurance for the mortgage, pretty much just guaranteeing that if you default on the loan, that the bank will be able to recoup their costs from the federal government. Now, PMI kind of varies. You can talk to a local lender. I can put you in touch with one. But I've seen anywhere from $50 a month to $200 a month. So it's really going to swing, and that could be a significant difference in your down payment. It's going to make your offers look more appealing, but also you lose out on some of the protections of the other loans because, again, they don't really care a whole lot about the property condition besides it's livable. All right. NADLS. So this one, I have a little bit of a different info packet here for. So this is one that I've never personally done. So this is for Native American veterans. Right now, the VA has super low. If you go onto the actual VA website, they will have it stated on there that their interest rates right now are 2.5%, while everything else is 6.5%, 7%, 8%. So you're going to have interest rates. It's going to be substantially less. As far as the credit requirements, they do state that they have a credit requirement, but I looked around a bit, and again, I've never had to do this loan, but they don't tell you what it is. They do say that you can contact the VA directly. So unlike most loans, so let's say you get a VA loan or an FHA conventional, any of these other loan types, you're not making it with the federal government. You're not making it with the VA. These are just private lenders who are giving out these loans. So even though the VA loan you'd think would also be through the VA, it is not. There are no mortgage companies exclusively connected to these federal entities. But for this specific loan, it is through the VA itself. So down payment is 0%, no PMI. I will say that the requirements are pretty stringent, so you need to be a veteran. You also need to be part of a Native American tribe, and this has to be built on improvements for tribal land. Now, this could be for purchasing or building new properties or developing land. Alright, so USDA is a pretty neat program. You can actually go onto the USDA.gov map, and it'll show you kind of what areas encompass this. But it's a very area-specific loan. So property conditions, it has to be in good condition. It's going to be very similar to what we're going to talk about next, which is FHA. They don't want any broken windows. They don't want any peeling paint. They want to know that, there's railings on the stairs and that the area is livable, it's in good shape. It is going to come with a higher credit score requirement of 640, but you have a 0% down payment with no PMI. So that's going to save you a significant amount of money either up front or even in your monthly payment. So the whole point of these loans are that it's going to be for developing more rural areas. Think farmland outside of big cities. Here in Muskegon, well, the city of Muskegon won't count because it's more developed. If you go just outside, maybe 10, 20 minutes, you can qualify. Same thing if you go out towards Grand Rapids. Just because Grand Rapids doesn't count doesn't mean the surrounding area like Sparta doesn't. So there are ways to go about this, especially if you live in a bigger city and you want to move kind of outside of it, maybe get a good deal while you're at it. FHA is probably the most used loan that I run into. Again, it has that same property conditions of USDA. It needs to be in good shape. Nothing crazy. Credit score needs to be 580. So it's got the lowest credit score out of anything else on this list. Now, 580 could be difficult for some people to reach, but it is much more attainable than 640. If you're already hurting from bad credit, it could be something where you come up with a 6-month plan to fix that credit score with whoever your credit professional is, whether it be a lender or a credit repair company or even just a realtor you're working with. Getting that 580 is reasonably attainable. So the down payment on this is 3.5%, so it's a little bit higher than a first-time home buyer for a conventional loan. PMI is 20%. If you pay 20% off up front, then you don't pay that PMI. Now, this is a little different than PMI with conventional, not as far as pricing, but when it goes away. So with conventional loans, if you pay 20% of your loan off, it disappears. So you don't have to get a new loan. You don't have to refinance. Nothing like that. With FHA, that PMI does not drop off automatically. So if you were to go ahead and pay down over time 20% of the total loan value, you would still be paying PMI. You would need to refinance. It's not as good as conventional as far as that goes. You're going to wind up taking longer to get that PMI paid off if you can't do 20% up front. But as long as you don't plan on paying it down within a year, I don't think it's that big of a deal. You can always refinance down the road, get a lower monthly payment, and also be able to go ahead and drop that extra monthly payment for that mortgage insurance off. All right, we're here on the last standard loan on the list, and that's going to be VA loans. Property condition is actually more strict. They want termite inspection as well as septic inspections. They want proof that there isn't any peeling paint. I've actually had them require entire garages be torn down because there was a crack in the foundation of it. So they are a lot more strict with their requirements. Credit score requirement is 620. Benefit is 0% down payment. And PMI don't really have PMI, but they have a variation. So VA, in order to actually get a VA loan, you need to be a veteran. You have to have served on active duty or 90 days active as a reserve. If you have a disability rating of 30% or higher, you also get rid of the mortgage insurance that the lenders could require you keep. So that could wind up saving you quite a bit of money with the 0% down payment. They always give you kind of a lower interest rate on it. It's just a good deal if you're a veteran. All right, so some stuff I want to go over really quick with loans in general. So let's say FHA, VA, conventional, all of these loans, you can actually buy those multifamilies like I mentioned before. So you could buy a 3-unit, 2-unit home, rent out half, have them cover your mortgage, and live in the other. It's called house hacking. It's great, especially if you're just starting out or you want to get into real estate investing. Just make sure that you plan on living in that property. You cannot buy these as a primary home and then rent out both sides. You're going to wind up getting in a lot of legal trouble. It's not worth it. Stay above board. But it is a good way if you want to go ahead and get a conventional FHA, VA primary home loan. And then, 2-3 years down the road, go ahead and buy another one, and then another one. And you could wind up with, 5 or 6 rental properties by the end of it, as long as you're doing it within law. So that's going to be it for today. We're going to go ahead and move into section 2.3. If you got any questions, feel free to reach. If you got any questions, feel free to leave them in the comment section down below. Like and subscribe to the video. It helps me out a ton. And if you have any questions, my contact info is going to be right after this on the credit screen. I hope you guys have a good one.